The Rubber Estate's Ledger, a tale of Vallambrosa. In the rolling hills where the mist clings to the canopy, Silas oversaw the vast Vallambrosa rubber estate. It was a land of quiet patience. Row upon row of heavier trees stretched toward the sky, but only a small fraction, just 1/7 of the forest, was mature enough to bleed the white latex that filled Silas's coffers. The rest were mere saplings, dreaming of the day they would finally reach productivity. Every year, Silas spent a fortune tending to his entire estate. He paid for weeding, for pest control, and for the careful nurturing of every tree, whether it was a tall giant or a tiny sprout. To Silas, this was the cost of doing business. You cannot have a forest without tending to the young, just as you cannot have a harvest without the sowing. However, when tax season arrived, a stern man named Caselaw, the revenue assessor, visited the estate. Caselaw looked at Silas's accounts with a sharp eye and a heavy pen. "You are claiming deductions for the maintenance of the whole estate," Caselaw noted, his brow furrowed. "But 6/7 of your trees produce no income yet. Therefore, those expenses are not deductible." Caselaw argued that the money spent on immature trees was a capital investment, an expense to create an asset for the future. He claimed it fell under the prohibitions of what we now know as Section 11(2) of the Inland Revenue Act, which bars deductions for capital nature. He insisted Silas could only deduct expenses for the trees that were currently yielding rubber. Silas took his grievance to the High Court, where Judge Solon presided. The courtroom was silent as Silas explained that a rubber estate is a single, organic entity. To stop weeding the young trees would be to let the jungle reclaim the future of his business. He argued these were ordinary, recurring expenses necessary for the production of income, satisfying the spirit of Section 14. Judge Solon leaned forward, offering a simple analogy. "Suppose a fruit grower has 1,000 acres, the judge began. Each year he must tend to the whole orchard, even though only a portion of the trees bear fruit in a given season. He does not plant them once and for all and walk away. He must maintain them every year to ensure his business survives." The judge then delivered a rule that would echo through the halls of accounting history. "Capital expenditure," Solon declared, "is a thing that is spent once and for all. Revenue expenditure is a thing that is going to recur every year." Because Silas had to weed and tend his trees annually, those costs were revenue in nature, not a one-time cost to bring a new asset into existence. "Under the modern framework," Solon continued, "we look to Section 14. An expense is deductible if it is incurred in the production of income. Even if those specific saplings aren't producing today, the process of tending them is part of the ongoing business of a rubber planter. It is not like buying a new machine or building a factory, which would fall under Section 15 or 15A for capital allowances." The court ruled in favor of Silas. The Vallambrosa rule was born. The fact that an expense does not produce immediate income in the year it is spent does not make it capital. As long as the expense is a recurring necessity of the trade, it remains a revenue deduction. Silas breathed a sigh of relief. His estate was saved from an unfair tax burden. Silas returned to his hills, knowing that every weed pulled and every sapling fed was a recognized part of his journey. He understood now that the law, much like his trees, required a balance between the investment of today and the harvest of tomorrow. And so, the Vallambrosa estate flourished, a testament to the recurring cycles of nature and the clarity of the law.